Imagine this. You've just checked your accounts and there it is. A net worth of $250,000 staring back at you. Maybe it took years of grinding, smart saving, and watching every penny. Or perhaps the market gave you a nice boost lately. Either way, that number hits different. It's not just money anymore. It's freedom starting to take shape. It's the point where your wealth begins to work harder for you than you do for it. But here's the exciting part. Hitting $250,000 isn't the end of the journey. It's the launchpad. From here, the right moves can snowball your money faster than ever before, turning that $250,000 into $500,000, then $1 million, and beyond. Today, we're diving into the genius money moves you can make once you cross this milestone. These are proven practical steps that wealthy people use to accelerate their wealth growth. Stick with me, and you'll have a clear roadmap to the next level of financial independence. First off, let's acknowledge a major milestone. You've already done the hardest part. Hitting a $250,000 net worth demonstrates solid financial habits. Living below your means, avoiding high-interest debt, and investing consistently. But as your net worth grows, your financial strategy must evolve. The basic tactics that got you here aren't the same ones that will take you to your first million. Think of it like climbing a mountain. The base requires grit and stamina. But as you reach higher altitudes, the terrain changes, and you need specialized equipment and strategy to navigate the summit. At this stage, small upgrades in your strategy can add hundreds of thousands or even millions over time because of compounding. That's the power we're tapping into today. Compounding turns your money into a machine that works 24/7. And at $250,000, it's starting to build serious momentum. One of the smartest shifts you can make right now is bolstering your emergency fund. When you were building from zero, a small cushion like $1,000 or even $10,000 might have felt sufficient. But with $250,000 in net worth, a significant unexpected event, like a job loss, medical bill, or major home repair, could undo months of progress if you're not protected. Aim for 6 to 12 months of living expenses in a high-yield savings account or another highly liquid option. If your monthly expenses are $5,000, that's $30,000 to $60,000 set aside. Currently, in late 2025, top high-yield savings accounts are offering up to 5% APY from various financial institutions, with many reliable options in the 4–5% range. Park your funds there so they grow safely, insulated from stock market volatility. This may not be exciting, but it's a foundational move because it provides peace of mind. You avoid dipping into investments during difficult periods, which means you prevent selling low and missing out on recoveries. Those who build substantial wealth sleep easily, knowing their foundation is secure. And this buffer allows you to take calculated risks elsewhere, such as in your investments. With that safety net strengthened, it's time to consider protection on a larger scale. Insurance and estate planning. As your wealth grows, you have more to lose. From lawsuits, accidents, or ensuring a smooth transfer of assets. Review your life insurance. Term policies are cost-effective and can cover 10 to 20 times your income if you have dependents. Disability insurance is also crucial. It protects your greatest asset, which is your earning ability, especially if you're in a high-income profession. And don't overlook umbrella liability insurance. It provides additional coverage for major lawsuits beyond your auto or home policy, often for just $200 to $400 a year for $1 million in extra protection. That's a modest price for significant security. On the estate side, establish a basic will and trust, even if starting with a DIY approach using online tools. Designate beneficiaries on all your accounts to avoid probate complications that can delay and diminish what you leave behind. These steps may seem mundane until they're needed, but they are a brilliant way to safeguard everything you've built for your loved ones. Consider this: one major lawsuit could undo years of progress, but these measures act as a shield. Now, let's discuss taxes, because keeping more of your money is one of the most effective ways to build wealth. At a $250,000 net worth, you're likely in or approaching a higher tax bracket, particularly if your income is also rising. Start optimizing. Maximize contributions to tax-advantaged accounts like your 401k. Especially if there's an employer match, that's free money you should not miss out on. Contribute to HSAs if eligible, to benefit from triple tax advantages: pre-tax contributions, tax-free growth, and tax-free withdrawals for medical expenses. Consider Roth conversions in years when your tax rate is lower, allowing you to pay taxes now at a reduced rate. And look into tax loss harvesting in your taxable investment accounts, selling underperforming assets to offset gains and lower your tax bill. If you have rental income or side businesses, explore deductions like depreciation. The less you pay in taxes, the more of your money compounds over time. Wealthy individuals focus intently on this. It's akin to receiving a raise without additional work. Over the years, astute tax strategies can save you tens or hundreds of thousands of dollars, which then grows exponentially. Speaking of investing, this is where true acceleration happens after reaching $250,000. Up to now, you may have taken a conservative approach or simply invested in index funds, which is wise as the S&P 500 has historically returned around 10% annually, including dividends over the long term. But now, diversify more strategically. Maintain a core position in low-cost stock index funds for growth. They have been the foundation for many who build wealth. Add bonds for stability as you get older, perhaps shifting to a 60-40 stock-bond allocation or another mix that matches your risk tolerance. Also consider expanding into real estate, maybe your first rental property or REITs for passive income without the responsibilities of direct management. Using leverage, such as a 20% down payment, $250,000 could control over $1 million in property value, building equity and generating cash flow. Alternative investments like private funds or peer-to-peer lending can add further diversification, though it's important to stick with what you understand to avoid risks. The key is to rebalance annually, selling assets that have performed well to buy those that have lagged, and to remain invested through market fluctuations. Don't try to time the market. Time in the market is what leads to success. Compounding at this level is formidable. At 8 to 10% average annual returns, your money can double every 7 to 9 years. Let's explore real estate as an option in more detail. Many people at your stage begin with a single rental property in a growing area. It can provide rental income to cover the mortgage, tax advantages such as deductions for interest and depreciation, and long-term appreciation. Or, if hands-on management isn't for you, REITs purchased through your brokerage offer exposure to real estate with liquidity and dividends. Another approach: consider side ventures or business investments. With $250,000, you might fund a small business or make angel investments in startups, but keep these allocations small and diversified. The goal is to create multiple streams of income so your wealth isn't reliant solely on your job or the stock market. Another intelligent move? Engage a professional. When your net worth reaches this level, a financial advisor or planner can provide value that far exceeds their cost. They identify blind spots, optimize your tax situation, handle estate planning details, and create a customized strategy for you. Look for fee-only fiduciaries who charge a flat fee, an hourly rate, or around 1% of assets under management, typically $2,000 to $3,000 annually for a $250,000 portfolio. It's like hiring a coach when you're already skilled to reach an elite level. Many successful individuals rely on this. It frees up your time, reduces emotional decision-making during market downturns, and often enhances returns by 1 to 3% annually through better planning and tax efficiency. Don't forget to maintain an aggressive savings habit. Even with investments growing, those who save consistently come out ahead. Aim to direct 20–50% of your income toward building wealth. Automate the process so the money moves before you see it. Use direct deposits into investment or savings accounts. And if lifestyle inflation begins to creep in, a larger home, a more expensive car, luxury vacations, pause and ask if these align with your long-term objectives. Those who build wealth often delay gratification now to accelerate financial freedom later, such as early retirement or financial independence. Use budgeting apps to track your spending and stay mindful. Small ongoing expenses can gradually undermine your progress. Beyond that, manage debt strategically. If you have low-interest debt like a mortgage, it may make sense to keep it and invest instead, since potential returns often exceed the interest rate. But high-interest debt should be paid off aggressively. It's a guaranteed return on your money. Also, focus on building multiple income streams. Dividends from investments, rental income, or even a side pursuit based on your passions that could grow over time. As you implement these strategies, track your progress monthly or quarterly. Use tools like spreadsheets or financial apps to monitor your net worth, investment returns, and savings rate. Set clear milestones: $500,000 next, then $1 million, perhaps with small rewards along the way. Continue learning. Read books like The Millionaire Next Door, or follow trustworthy financial sources. Surround yourself with like-minded people who prioritize building wealth. Your $250,000 today could readily become millions with time, consistency, and these steps. You've already demonstrated you can do difficult things. Reaching this point shows a discipline most people lack. Now watch your money do the heavy lifting through compounding and thoughtful choices.